Hey everyone, welcome back to the channel with me, Fawad Razaqzada, StoneX market analyst. The Japanese yen is back under pressure after reports suggested that Prime Minister Takeichi voiced caution about further rate hikes during a recent meeting with the Bank of Japan Governor Ueda. So what does it all mean for the dollar yen? Well, in short, I think it points to only a temporary strength in the dollar yen currency pair. Let's get into it. According to local press, Takeichi struck a tougher tone on monetary tightening than in previous discussions, and markets reacted immediately with the yen dropping around 1%, making it the weakest performer across G10 currencies at the time of this recording. Since taking office, Takeichi has tried to soften her earlier reputation as a policy dove. More recently, however, her tone has shifted, particularly after the Bank of Japan raised rates in December to their highest level in 3 decades. Still, credibility is fragile. Currency markets are extremely sensitive to any hint of political influence over central banks. If investors believe the government may lean on the Bank of Japan to slow tightening, the immediate result is usually a weaker yen. And that creates a policy dilemma. A softer currency can push up imported prices, complicating Japan's inflation battle. Whether the Bank of Japan will comply is another question. Governor Ueda previously stated that no specific requests were made during the meeting with Takeichi and that discussions were broad-based. After December's rate hike, market expectations pointed to the next move coming in the summer, but ongoing weakness in the yen has pulled forward some forecasts. Rate futures imply roughly around 60% chance of a hike by April, with a quarter-point increase largely priced in by July. That suggests that traders still see gradual policy normalization, though with uncertainty around the pace of it. The bigger question now is whether any perceived attempt by the government to slow the Bank of Japan could create tensions with the United States. A weaker yen makes Japanese exports more competitive, but it's not something Donald Trump would welcome. On the dollar side, meanwhile, data has been mixed lately while renewed trade tensions have come back to the forefront. The greenback has managed to bounce back against most major currencies, but whether it can kick on from here remains to be seen. Now let's turn our attention to the technical picture in the dollar yen currency pair. Despite today's rally, the dollar yen has not yet broken the broader structure of lower highs that has been in place since rates peaked in January. The key level to watch on the upside is at 157.66, the most recent swing high. As long as that level now remains intact, the broader bias leans to the downside. Right now, price is testing resistance in the 156 to 156.50 zone. This area previously acted as support and also aligns with a shorter-term trend line connecting the recent lower highs. That makes it a significant technical confluence zone. On the downside, first support comes in at 155.65, last week's high. Below that, we have 155, which is another key level marking Monday's high. If we see a daily close below 155, that would be a bearish signal in my view, and a break under 154.52 would strengthen that view, potentially opening the door towards the low 150s again. But we will cross that bridge if and when we get there. For now, watch price action closely because in this environment, headlines may spark the move, but technicals will confirm it. If you found this useful, hit the like button and subscribe for more analysis. Thanks for watching, and I'll see you in the next one. Take care.